So what's the truth about our economy? What happened to the markets in 2016 and what should investors expect as 2017 unfolds? My name is Jared Knoll, and right here at Piney Woods Financial, we want to help protect your financial future and keep you informed along the way. So with this in mind, I'm going to take the next 15 minutes or so and devote them to you and our 2017 Kickoff State of the Markets address. Thanks for joining us. Before we get too far, I would like to draw your attention to some of these disclosures to help keep compliance and the regulators happy. And now on to what we're going to talk about today. Again, this will cover what happened in 2016, what affected the markets, and also what could we look forward to in 2017. As we look at this chart for the S&P 500 index for 2016, you may remember that our economy and our stock markets started with a major sell-off with fears from a decrease in the Chinese economy. As the Shanghai index fell, so did ours, with one of the worst weeks as we've ever seen. Throughout the year, there were other things like the vote for Great Britain to leave the European Union, better known as Brexit, and that sent the markets into a turmoil for about a 3 or 4 day period to where the markets went down 1,000 points. In November, we experienced one of the most divisive elections in U.S. history, and many people were surprised to see Donald Trump become president. And then in December, the Fed decided to raise interest rates. There was definitely some growth over the course of 2016, but it was by no means a smooth ride. When we take a look at all of the economists from the major banks and credit institutions that were making predictions over the year ahead and investment firms, you'll see that many of them predicted that we might see growth for 2016 at around 7%. Much to everyone's surprise, though, we still saw growth of about 9.5% for the S&P 500. One of the things that it's important to keep in mind is that it's very important to have a diversified portfolio. When we look at the first half compared to the second half of 2016, you can see that in the first half of the year, information technology and financial companies were the lowest performing indexes and sectors that we could have been in. While the second half of the year, they were by far the best performing that we could have been in. And if you look at utilities, well, they made their way down to the bottom. So what other factors affected the markets in 2016? We'll take a look at the labor market, some information on manufacturing. Oil and gas has been a big impact on the economy for the last several years. We'll talk about investing for businesses, some global growth, and one of the other things that's always a concern for folks in and nearing retirement, inflation and interest rate increases. In many ways, 2016 was a good year for the American worker. We've seen job growth for the last 75 straight months, causing the official unemployment numbers to drop to 4.7% and also increasing wages. Manufacturing has been a concern for many folks as they try to look at the data, but by looking at this chart, you can also see that there's been productive history in manufacturing growth for the last 40 years. We can also talk about our U.S. economy still being the largest in the world. We're still ahead of China, Japan, and Germany by a long shot, and we can look independently at U.S. manufacturing to note that just that part of our economy alone is the 10th largest economy in the world if it were to be separated out by itself. And at the same time, our U.S. oil and gas industries would be the 17th largest industry in the world. Speaking of oil and natural gas, 2016 did mark a landmark year. We had our first export of oil from Corpus Christi in more than 40 years, and we've also seen the first export ever of liquefied natural gas, meaning that we have a broader market base to sell our natural gas to. We can also look at manufacturing from a global perspective, and we can start by looking over at the left-hand column of this chart, and you'll see in the left-hand side of the chart that there is more yellow and red than there is over on the right-hand side of the chart. So as you could imagine, yellow and red indicate that manufacturing has slowed, while green, as noted in many of the columns on the right-hand side of the chart, shows that manufacturing is actually growing on a global basis. Let's talk about inflation for a moment, as it is one of the key economic indicators. Generally speaking, stable, modest inflation is better for the stock market. Take a look at the box in the middle of the chart and you'll see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation, shown by the yellow line. Now, core CPI strips out volatile food and fuel prices to focus on long-term inflation. You can see that the yellow CPI line jumps around much more than the darker gray core CPI line. That's because food and energy prices tend to be very volatile in the short run. As of November 2016, the headline CPI was 1.7% and well below the 50-year average, and very close to the Federal Reserve's 2% benchmark. One major indicator that we like to look at to gauge the economy's health is consumer sentiment. This is essentially a survey that asks regular Americans how they feel about the economy and their financial prospects. Consumer sentiment can be a rational reaction to a strong economy. A high level can also be a sign of irrational investor enthusiasm when increased to unsustainable levels. For 2016, we ended with December's reading reaching a 12-year high, but we will still keep an eye on consumer sentiment because it can indicate that the market could trend downward. I like how Warren Buffett phrases it best. Be fearful when others are greedy, and greedy when others are fearful. And what does that mean for us? Don't get too caught up when others are thinking or doing. Be cautious, watchful, and prudent about managing risk, even when the crowd is going the other way. So what's on the horizon? Let's take a look at some of that now. Some headlines and news companies are predicting a positive view, which we hope for your sake comes true. And others are a little less optimistic. Of course, we still don't know how all of the economy will be impacted by policies and regulations from President Trump, but we are keeping an eye out on them. So if we're facing uncertainty along with positive opportunities, do we have to worry about a 2017 recession? Let's look at a group of indicators that can help ground our predictions in data. This slide takes us back to early 2008. Here we see a group of 20 indicators that help forecast what pressures will be acting on the economy in the next 3 to 6 months after the report. Green is positive, yellow is caution, and red is a headwind that acts as a brake on the economic growth. In January 2008, about 8 months before Lehman Brothers collapsed in September of 2008, you can see a fair number of yellow and red indicators, long before the recession actually started. The economic outlook was negative, energy prices were rising, and the housing market was also a red flag. Fast forward to December of 2008, and red emerges on the board. The economy was in serious trouble. The housing market was deep in the red, volatility was high, the global economic outlook was negative, and business spending was dropping. So now let's look at December of 2016. You see a lot more green on this board. In fact, the only red board on the board came from the political environment. At this time, most all of the indicators are strong, but keep in mind this is only good for 3 to 6 months at a time, and we're not making long-term growth predictions and do not advocate trying to time the stock market. But are equities or stocks overvalued? That's a common question we hear. On this chart, we want you to see that many company stocks are still fairly priced. A PE, or price to earnings ratio, shows the price of a stock as compared to the company's earnings. A high PE means stocks are relatively expensive. Here, we are still close to the 25-year average. One reason consumers may feel better is that their debt ratios, or amount of debt payments to income, has gone down, providing for more discretionary income. And household net worth has also increased. I know these are both components that help brighten my day and probably yours too. What should we look forward to for the rest of 2017? If President Trump is able to fulfill most of his agenda, we expect to see inflation rise some. However, we don't expect it to reach uncomfortable levels like some of your painful memories of the 1970s and 80s. The Federal Reserve has predicted 3 interest rate hikes over 2017 and has completed 1. Rising interest rates are good for savers in the economy as a whole, but we do not expect interest rates to increase at a rapid rate, so you won't be seeing the nostalgic 10% rates on your CDs anytime soon. Historically, this chart shows that a rise in interest rates has been good for stocks as long as interest rates stay below 5% on 10-year treasuries, shown on the yellow dotted line. While a rise in interest rate is good for a lot of savers, it can be negative for those invested in bonds and bond mutual funds. As interest rates increase, the value or price of existing bonds will go down. It will be important to pay close attention to your bond funds over the next few years and make sure you have a proper cash reserve for rainy days. We are continuing to watch these closely in our managed portfolios. GDP, or gross domestic product, is expected to see steady, moderate growth, and unemployment should continue to drop even further. As we watch unemployment numbers decrease, the gray line, we should naturally expect to see some of the wages increase along the way. It's still going to be important for you to be careful how you ask your bosses for a raise, though. They may still be less optimistic than some of the economists. Now, the same investment bankers, economists, and analysts that we looked at earlier have predicted an end-of-year S&P 500 value of 2359. We have already hit this mark and are unsure as to how much more growth is possible. This chart shows that there was optimism for the economy. Our continued mantra is to proceed with caution. It is important to remember that each year will have its ups and downs, some more than others. The yellow line shows the actual growth or decline of the S&P 500 for the year. The red dots indicate how low the S&P 500 declined within that same year. You should pause this to look at the data more closely. You may be surprised. You must have some money that you can access for current and near-term needs, and it is often prudent to have some monies invested for long-term growth and inflation protection. If you followed us for very long, you will know that our personal risk tolerances are very conservative. But we know that each of you have your own lifestyle and investment goals, and our intent is to help you reach those milestones as smoothly as possible and enjoy your retirement. We do ask that you keep us informed of what you're going through. We value your trust in our relationship and want to know of any concerns you may have. Our goal is to keep you informed of economic changes and to monitor your accounts. We will make adjustments as necessary to help keep you on track to meet your goals. Thank you so much for your time today. We love helping and educating our clients and hope you enjoy this new format. Go ahead and send this out to a couple of your friends with the forward button in the email. And lastly, please contact us if you would like to schedule a personal review of your accounts or subscribe to our email newsletter. Have a great day.